Hi everyone and welcome. I'm Gareth Brown and today I'm joined by my fellow portfolio manager on the Forager International Shares Fund, Harvey Migotti. Hi Harvey.
Hey everyone, how's it going?
Today we're going to talk to you about markets in general, but in specific, the smaller cap end of the market. The broader market has been going fairly strong over the last couple of months. It's up about 1% since the 30th of June in the US. But the smaller cap end, that's hiding a pretty sharp sell-off in the smaller end of the market.
Yeah, no, that's right. So if you scratch the surface, you see that the Russell is up 1.5%, but underlying, there's been a lot of market rotation and actually quite a lot of pain. So for every Google and Alphabet and Apple that has grounded higher since the end of June, the Russell is actually down 6%. So that's 7.5% underperformance versus the broader larger cap index. Now, the larger cap index, as of the last few days, is also starting to move downwards. And there could be some convergence, but there's been some pretty big underperformance. And quite frankly, it's created some bargains as well in the process.
Now, that smaller end of the market is an area where we have a competitive advantage at times finding attractive investments. So it often makes a decent part of our portfolio. I think we've played it relatively well. We were selling quite aggressively a lot of these stocks that have done well in May and June, but we have been caught up in the downturn. So, it has impacted performance somewhat as can be expected. I thought a useful thing to talk about today, there are some of these stocks that we've gone through reporting season. Some of these stocks are probably deservedly in the penalty box for now. They haven't done so well, but we also have quite a few stocks that have just kept performing very, very well in terms of operating performance, and they're getting caught up in the downdraft. And it's sort of an area for us where we can often add to positions. And so I thought maybe we'd talk about a few of those. Maybe we can start off with open lending.
Yeah, no, 100%. And what I would say is when we looked at our portfolio, I would say a good 75-80% has actually beaten and raised and surpassed expectations. But since the whole market is sinking, they're a bit tied up. And when you compare them relative to a Google that's been very resilient, there's a disconnect brewing. So great opportunity, I think, for the next kind of 6 to 12 months in a lot of these names. Yeah, so open lending in particular had a really good set of results. The company's growing well over 100% year on year. The growth is set to be, call it 30-35% over the next few years per year. Pretty incredible, and the business is still very attractively valued. You look at the price to earnings multiple, it's much more fair than many other names that are growing similar amounts, particularly names in the software space or some of these sectors that are still very, very hot. So that's one that we continue to like. And because, the company is beating expectations and taking numbers up, it's getting actually cheaper on a valuation basis. So, we actually did top up that position after the numbers, and we've actually seen a bounce in that one. It's one of the few that's
done quite well over the
last few weeks.
Last month or so.
Yeah, no, that's right. So that's open lending.
Okay, let's move on to Fathom. Fathom is a disruptor in the real estate brokerage area in the US, really a software provider. Could we maybe outline the situation there?
Yeah, so Fathom is kind of a digital real estate brokerage. Imagine a broker without any bricks and mortar properties, where an agent can join and they have all the tools they need to get the leads, to close transactions, etc. It's growing really rapidly, call it 70% year on year during the last quarter, and set to continue. They're taking a lot of share and they have a lot of agent growth. They have a pretty disruptive model where the agent pays a fixed fee per year to the company rather than a big chunk of every house sale, and that's causing a lot of agents to come to the business. Now, how do they make money, you might ask, given that they're doing this? Well, it's through all the bolt-on capabilities that they're starting to offer.
This ancillaries, right?
Yeah, ancillary products. So mortgage titles, and so forth. And also, obviously, lead generation. If Fathom actually generates the leads, the agent goes and sells the property, there is a profit split. So it's a really beautiful model. And here we have a business growing 70% year on year. That's surpassed expectations every single quarter since it's been public just over a year ago. And has, derated quite a bit over the last kind of 4 or 5 months. Again, a great opportunity. We've increased our size in that company. We love the management team. It's founder-led, significant stake in the business. and we think the company has a bright future ahead of it. So, very positive on that one over the coming months.
One from my sphere of influence is lastminute.com, which is an online travel agent and a seller of packaged holidays in Europe to the big 5 countries in Europe. I think it's really been left behind in this travel recovery that's going on. It might be something that's new to a lot of you out there, but Delta is not really having an impact on travel in Europe. The recovery is continuing apace. We have stocks like Wizz Air that are hitting record highs, Ryanair back towards the highs. Recovery is accelerating. You look at airport numbers. So I'll give you the numbers for Vienna because I know them the best, but back in May, throughput at Vienna was down about 86% versus the same month in 2019. So that's the same month pre-pandemic. In June, it was down 75%. In July, it was down 53%. And in August, it was down 44%. So just a rapid recovery there. And you can't even see Delta in terms of the numbers. People are getting back to the skies. My in-laws were traveling through Vienna airport the other day and said it felt as busy as anything they'd been through there pre-COVID. The opportunity here is the Last Minute has done a very good job at cutting costs out of its base. So by the month of June, it was back in profit again, made about 4 million of net profit in the month of June, which was in line with the same month back in 2019. And it did so with sales significantly lower than what it had 2 years ago because of the pandemic. We're seeing a recovery happen before our eyes in terms of traffic taking back to the skies in Europe. Now, of course, we're in the tail end of the European summer holiday period. This gets quiet now for a few months, but it bodes very well for 2022. So early indications are the financials there are really starting to stack up. The market's ignoring it. It's back down towards recent lows.
Yeah, no, it certainly feels like an opportunity. And I mean, I bet most of us here in Australia can't wait for everything to reopen and flood out and go on our holidays and see family abroad and so forth, provided the flights are cheap enough.
I'm hopeful I can do our Christmas video from Vienna, but we'll see.
Yeah, fingers crossed.
Look, that's probably a good spot to stop. We're working hard, looking to find the next new opportunities in the smaller cap area and indeed across the world of opportunities available to us. Thank you very much for your time, and we'll tune in again in the next couple of weeks and give you an update. Thanks very much.
Thank you.